folks. We'll be getting started in a few minutes.
Lisa, are you there for a quick question before you start?
Yes, I am.
I've got to run. Unfortunately, I can't stick around, so I wanted to see, is it going over the same strategy that you showed last week, or is it different?
It's different that I applied it to a sideways market, and I looked at what would happen if you did a trail stop versus a free trade method with a trail stop, or if, since it was a sideways market, if you just took one-to-ones.
Okay. I'll have to catch the video of it then.
Okay. Yep.
But, and the other thing, check your time. First, it's daylight time, not central. And so it's 7 p.m. Eastern Daylight, isn't it, when it's starting?
It's, yeah, the calendar is always central.
Right, and it says 6 p.m. Central Daylight. So it's going to be, so if this says Central, which is what the C is, we're in daylight everywhere except Arizona, no, I think. And so that would be 7 East Coast.
Right.
So it starts like at 6 o'clock East Central, excuse me, it starts at 6 o'clock Central, which is like in 4 minutes, right?
Correct.
Yeah, so 7 CST is Central Standard Time. And it's not starting at 7 Central Standard Time. It's starting at 6 Central Daylight Time.
Okay. I don't know how to change that. We'll have to ask Tim.
Central Standard would be 5 p.m. technically, because we sprung ahead. So in 4 minutes, it's going to be 6 p.m. Central Daylight Time or 5 p.m. Central Standard Time. So you're actually off by 2 hours there.
Yikes. Okay.
I got to run. Good luck.
All right. Have a good one.
Thanks.
All right, good afternoon, folks, those that are in the Zoom room and those that are watching on the live stream. If you have questions and you are on YouTube, you can just put your questions in the comments. If you are here and you are comfortable, you can use your mic or you can put questions and comments in the chats. Today, we're going to continue our series on entries and exits, and we're going to talk about some of the strategies that we've looked at in prior meetings and applying those to a sideways market. So the question was, what performs better in a sideways market? And I'll show you what we mean by sideways market in a second. But what performs better? One-to-one contract trades where you just take whatever the band size is and whatever your risk to reward is and just trade one-to-one. So you're just taking little bites out of the market. Or number two, what if I trade two contracts, take the first contract off at one-to-one, so I'm in a free trade situation, and then I use the trailing stop rules we've been using over the last couple weeks. The third option is, what if we just use one contract and use the trail stop rule? So those were the three scenarios that I looked at in application to the sideways market. So for those who may not have been in other sessions, let me give you a quick overview of the entry rules we were using in a trending market. We were entering the trade with the trend. The band, the stop was going to be 3 ticks past the distal. We had switched from trading one contract to two contracts, leveraging the free trade method. And if we had the trend continued to go in the direction and we created a new band, we had permission to add 2 more contracts with each newly formed band when price came back and touched that band. And that as we were doing our trail stops, because the way we were doing the stop was, once we started the stop and trail stop with the original first band, that was the stop for all subsequent add-on trades. But we had an instance where the trail stop actually, and the normal stop that we'd use on the initial entry band, that would have been past the trail stop. So we said, okay, if that happens, we're just going to take that band for a one-to-one. We're not going to try to take it for any kind of extended trailing. And to get more info on that, it's best just to go back and look at the other videos. Our trail stop management was, once price hit one-to-one, we were going to trail by 3 bases. And I'll show you that on a chart. And additional contracts, we're going to use the trail stop, not the typical band stop. And we were going to use, when we set the trail stop, we were going to use the high of the base if we were shorting, or the low of the base if we were going long. And anytime we had 2 consecutive stop outs in a row, we were going to anticipate a trend change. Our exit rules, you can see in blue, we made a couple of changes after the first couple of sessions, analyzing what was going on, taking the first contract off at one-to-one, letting the second contract hit the trail stop, and exiting at one-to-one if the trend was not confirmed. So the results that we had played with so far, looking at the exact same spot on a chart in prior sessions, was the original method gave us about $4,800 of return over the 10-day period. And it required an account size of $10,000. The modified version that we did using the 2 contracts, we netted a little bit more. We netted a little, almost $5,100. But we had a situation where we had the trail stop exceed the original stop, and that did not end up in a good result. And if you had taken that trade, you would have ended up with $4,600, and it required a $1,600,000 account size because of the number of trades that were on simultaneously. So that's a very quick overview of where we stood. So let me take you to the charts. And so what I did was I first had to identify a sideways market. So let me adjust this just a tad. Let's see this better. All right, so you can see right here, we've got price chopping back and forth. And so this is what I would call a sideways market, because when price retraced back here, we did not exceed this low, and we did not exceed the original high. So we're starting this sideways chop. So this is where I wanted to test out and look at the strategy. So let me zoom in on this a bit here. So we were in an obvious downtrend, and price came back up here, and you got a swing. You got a lower swing high, but you're not getting a lower swing low. And at this point, because you've broken 1, 2, 3 bases higher, that can be an indication that price is actually going into an uptrend. So in this scenario here, we don't know what the trend is. So what I did is I looked at taking the trade here, and let's talk about the options of how to take this trade. First of all, set this up so you can see here, this was the stop for this first trade, T1. And so price came in. Now, if you'd have done your traditional stop at the distal, you would have been stopped out. But in this case, we were not stopped out, and price continued higher. And you can see you did achieve the 1-to-1. So that's what this green line is the 1-to-1. So this is where you would take off the first contract. So the different methods that we evaluated was, okay, what if I just take my contracts off at 1-to-1 and don't try to trail, versus when price meets 1-to-1 and I have 3 bases, I trail back 3 bases. So in this scenario here, you have 1, 2, 3 bases. And probably really you would be best served to put your stop here below this wick right here, even though it's technically not part of that base. But that's where it's important to kind of develop your own trade rules, your own trading style. And a lot of it has to do with the different markets. This was done on the 10-year, the 2584 tick bar chart. So it's not a fast moving whippy market. You get into some markets that have some more volatility in them, like say oil. You may see that you'll have to change the strategy, but this was really optimized for the 10-year on the 2584 tick. So So if you try to apply this to a different market, just beware that we have not looked at that at all. And so back to what we do. So we looked at the first method would be just taking off and only going 1-to-1. The second method would be using the free trade method, where you take the first contract off at 1-to-1 and then you start to trail the stop. Okay. So in that scenario, you would be looking for you've got, I really can't see it here, but you've got let me blow this up because I want to make sure you understand how we look at this. Right here, let me turn snap off. So right here, we have this base candle right here. Let me just change the color of this so it stands out. So you can see here we have this base candle. This next base here is actually just retesting back in to the original base. So I would not count this base here as a base. And that's just my personal way of looking at it. And if you're aggressive in trailing your stop with the actual bases that actually retest back, you may find that depending on the market and the volatility, that you could get stopped out a lot more frequently. So that's just kind of a lesson learned and a tweak I have made just to help me stay in the trade a little bit longer and maximize my profits. So let me get rid of that. Okay, so here, so as we're looking here, you got 1, 2, and then you have this third base here. But in this scenario, because this is a base high and not a base low, I would not count that as my 3 bases. So at this point, I've got 1, 2, 3 bases, and I would move. Let me just use this little yellow line here. So you could put, by the rules we came up with, you would put it at the low of this candle right here, this base candle right here. But like I mentioned, with having this right here, I might have considered putting it there. But that gets you there. Actually, you know what? Let's look at this. Oh, here's the original base candle. See, this is where you got to be careful. That's the reason I have an indicator on here, because I don't always catch it. This is the original candle that started. So yes, you would definitely be putting your trail stop right here. So you'd be moving a little bit, but not a whole lot. So let me subtract that down a little bit and widen that back up so we can see what happened. So you can see that price came back and you would have been stopped out here. So that would be what happened with T1. Now you could, the third option that we looked at was just trailing the stop. So in that scenario, you would have had your 1 contract and you would have gotten stopped out here. So based on your entry, you would have been negative, just using nothing but the trailing stop. So anybody have questions about that? If not, we'll go on and look at the rest of the trades for a minute. Okay, so as you can see here, this trade this band right here, as you came up, price came up, and then you're starting to make base lows. And so the next opportunity where a band was created that you could get in the trade was right here. And you might have gotten filled in the trade right here where it touched the proximal of the band. But that doesn't always happen, especially we found on the 10-year. Sometimes it can take, 2, 3, 4 touches of the band to actually get filled. So just that's our personal experience. So be aware of that if you are trading the 10-year. I think it pretty much goes I think the 5-year even might be a little more difficult to get filled on. So at this point, price comes up, you go in, you get in the trade, and you can see here that you do make your one-to-one. And let me get rid of some lines here to make this easier. I try to set these up so that you guys can easily see what's going on. So here's the original band with the stop. And so you can see here, price came down, did not quite make the one-to-one. So this would have been a stop out. So whether you were trading the free trade method, the trailing stop method, or the one-to-one method, this would have been a stop out trade. So let me fix this so we don't for that. So then the next trade that price gets into, and I want to make one comment here. As you look at price coming up into the T2 trade, you can see that it's broken 1, 2 bases at this point. So, that's where, if you're conservative, you might say, okay, I'm showing some strength. I would only want to consider taking a one-to-one in that scenario. But again, it's going to vary by your trading style. It might be, the time of day. Obviously, we're looking at 4 o'clock in the morning. You might not even be in front of your computer at that point in time. Or you might be somebody who writes and trades algos. And so that might be a trade that you would be taking. Okay, so then you can see here the T3 trade. It ended up being a stop out. And then the T4 trade came back. And let me extend this so you can see the T4. So the T4 price came in. Again, you're looking at the T4 trade being a stop out. So you can see that you are experiencing several stop outs using as you look at the sideways method. So rather than continue to kind of talk you through these trades, you can kind of see what is taking place here, and everything's chopping around. And what I did is I continued to take the trades in the sideways market and evaluate them until price broke these original swing highs that had happened in the past, showing us that there was a definite upward trend. So whether it had broken up higher or broken lower below the swing lows, that would have been my indication to kind of cut off collecting the data. So that's what I did. So let me show you what the data looks like here. So what we did is we ended up taking 10 trades. And as you see here, I did graph it. So the blue line here is the results of if you just took the one-to-one trades only for the 10 trades, and that resulted in a $93 return for the 10 trades. If you did the free trade method, it resulted in $500. Okay. And if you did the trail stop method, you ended up with $484.37. So not a whole lot of difference in those two methods. But what I really want you to see is look at your free trade method. You got, $656 a drawdown. That would be, in some cases, something that would make people pretty uncomfortable. So that's where looking at your trade strategy and determining and understanding, how much drawdown you could potentially get is really important, especially if you're running a smaller account size, because you don't want to get in a situation where you go underwater with your account and then you can't even trade until you refund it. So the trail stop method, you ended up with $400 of drawdown, and the free trade method, you ended up with $187 of drawdown. So you can see you don't get as much return here, but you do minimize your drawdown. So based on your account size and your personality and how much heat you're willing to take, those may be considerations. Now, one word of caution. This sideways market encompassed 10 trades. So I would want to see this evaluated for 30 trades in a sideways market to feel good about the results. I just didn't have time to do that analysis yet. But so 30 trades gives you a better feel for the performance. And, if you can do it in a couple different time frames, find a sideways market in 1 month and compare it to a sideways market in 2 different months, just to try to make sure that you're getting a good cross section and feel for how this will work. Because with all these strategies, they kind of work until they don't, and that's about all we can say about it. So that's how that data turned out. So that's kind of all I was going to talk about in the sideways market piece, but I was going to bring up, start talking about, we've kind of beat this different entry and exit strategy. We've tried a couple different things, giving you guys some ideas on how you can look at it. So it's time to just kind of move on and start doing a different exit and entry evaluation. So get this back on the slideshow here. All right. So, but before we do that, let's talk about a couple considerations that you might want to look at with this strategy. The time of day could be a consideration. How long it takes you to reach 1-to-1. You might want to look at that. You might, if the market is just chopping around, you might say, yeah, I'm just going to dump out after, X minutes or hours. Does the band size matter? There have been some folks that I know that have done some research on the 10-year, and they feel like it performs best in the 2 to 8 tick range. Again, we just looked at, what happens when you stay choppy, when you're not breaking the range. There's also, if the market is very, very strong trending market and you're not creating bases, you might want an alternate strategy for how you trail in that scenario. And then, how do you want to handle the change of direction? And would you want to consider exiting at a specific time of day? Now, let me show you this real quick. I am going to I did, as far as looking at the time of day that the trades are taken, I did have this set up so it highlights the start and finish of regular trading hours. So you can see that I've got this box here. So interestingly enough, you can see that this sideways choppy market that we were talking about actually occurred during regular trading hours. So, a lot of people think that sideways stuff only happens. So let me make this smaller so you can see kind of what is going on. So during the regular trading hours, you can see that sometimes you're trending and sometimes you're just really sideways chopping. So in that scenario, as you look at different markets and you look at how you want to enter and exit, one of the considerations you might want to look at is during the regular trading hours versus the overnight hours, what does the overall performance look like? Does it tend to be sideways? Does it tend to be trending? I know personally, I have found that with copper, trading it from 1800 Central to 2000 Central is the best time of day to trade copper, and I have the best results getting 1-to-1 and 2-to-1 trades during that time frame. So using the free trade method on the first contract and going for 1-to-1 on the second contract. So I think, and that comes down to the importance of knowing your market. One other comment I wanted to make, if you are looking at the 10-year market, one of the things that we see a lot is you will see these little 1-tick bands where, it looks like a good band, but it's only 1 tick. So if you go through it, it's a bust. So depending on how you do your stop placement, you'll have to take that in consideration. Normally, even with adding the 3 ticks, I'm reluctant to take a 1-tick band. They just don't tend to perform well. So let me go back over to the PowerPoint for a minute. Where did I go? All right. Okay, so now that we've kind of got everybody thinking about how to use the trailing base method and thinking about the trending versus non-trending market and how they could maybe use that technique, really feel like it's time for us to go shift over and start to look at something else. And so one of the things that I personally wanted to look at next is looking at scaling in on a lower time frame into a high time frame band to reduce my risk and to see if I can leverage that to get into better swing trades. So some of the thoughts that I personally had about ways to scale in, and I've seen people do different things, is some people will look at candles or the breaking of bases or the wait until a new band is created on a lower time frame and price comes back to retest it, or looking at swings. So let me just show you on a chart here real quick what I am thinking about. So if we were looking at a higher time frame chart, and this right here was the band of interest that we wanted to get in on, some people will take and wait for a red candle to be printed on the time frame, the high time frame, and then get into the trade. Some people will take and go to a lower time frame. So let's say you might be on a 240, looking at a 240 band and 240 minute. And so you might say, okay, well, I want to go down and look for the printing of a 15-minute red candle. Or maybe I want to go down to a 1-minute candle, and I want to see a supply created, and when price comes back and expecting price to come back and test it, and then get in the trade to ride it out of the bigger time frame band. And then some people are looking for the break of a base. So in this scenario, price came up in here. Let me put a little box around this. See, it didn't break until right there. Yeah. Change that color. Okay, so here's price comes into the band and it kind of chops around, and it actually doesn't break this base until this candle right here. Some people would get in the trade at that point. Now, if you go down to a lower time frame, say a 1-minute candle or 5-minute, just depends. It's relative to whatever time frame, high time frame you're trading. You could wait and get in, but you may find that if you're, depending on how you're setting your targets, if you're setting your target to the next opposing band, or you're setting your target, by trailing it or a percentage of the next opposing band, you may find that, it comes so far away out of the band towards your opposing band that you feel like you're giving up too much potential profit and it's not worth it. And then you also have to decide, if you're looking at a band like this, you want to see the band break. Well, if this is your entry, then one of the questions is, where do you put your stop? Because if you put your stop up here, you've still got a lot of risk. Even if you use the band, you can have a lot of risk. So there's kind of a lot of questions around how you could look at scaling in to a trade and doing it on a lower time frame, and looking at the different options. Another one is, if you're on a high time frame chart like a daily and you go down to a 1-minute chart, you could say that you want to see, a lot of people for trend, they like to see the well, we got a good example here. So, if you're wanting to see, your swing lows and a higher swing high and a higher swing low, and then a higher swing high, like here. So you've got one, these are pretty much the same. So this second, so you could say, okay, I want to look at a lower time frame and look for that indication that on that lower time frame that I'm seeing a trend change. So a lot of it, there's a lot of different ways to consider and look at trend. And and then you have to decide if I'm getting in on a higher time frame, but I'm going to use a lower time frame band or chart or a base, whatever method you use. Well, then how do you want to trail the stop? So those are some of the questions that I was thinking about would be good to evaluate over the next couple weeks and see what we might find there. So at this point, if you want to put in the chat on YouTube or the chat here or open your mic up in Zoom, do you have any other methods or thoughts that we should consider as we look at this? Okay. Quiet group. All right. So that's kind of where I'm going and looking at for future weeks. If you have suggestions, definitely let me know. Or if you are looking at a different strategy and you'd like to have an extra set of eyes to look at it and help you, do some back testing and evaluate it, let us know. We're always open to learning new and different things. But if we don't have anything else, I am going to wrap this up. All right. Well, you guys have a great rest of your week.